Good morning, everybody. Happy Friday, and welcome to this week's long-form episode on Mining Stock Daily. Thank you so much for tuning in throughout the week. Big news, we did welcome, big announcement, we welcomed in Michael McRae as the new correspondent for Mining Stock Daily this week. Mike's going to be helping us out, doing some more corporate updates and also some of the morning briefings moving forward. Him, along with our friend Ian Wagner, who's also be filling in from us from time to time. So we're moving in. We've got a lot of updates coming in, covering a lot of this market, not only with the equities, but also with the metals prices as well. And big news coming out, it seems, day in and day out. This week in the long form, we spent a lot of time talking about silver. I welcome in our old friend Michael Oliver from Momentum Structural Analysis. It's been a while since Mike's been on the podcast, but I tell you what, I promise you, the wait was worth it, because for the first time in I think many, many years, a guest of mine kind of left me speechless. So great update and great analysis here from Michael Oliver. Well worth the attention. I will say that we also recorded the video. So if you're listening to it in the audio section of the podcast, maybe go over to the YouTube channel and watch what some of the charts that Michael shares with us. Special thank you to Revival Gold, Integra Resources, Equinox Gold, and Vizsla Silver for the continued support of Mining Stock Daily. So let's jump into it, everybody. Here's Michael Oliver talking all things silver. All right, everybody, welcome to this week's long-form episode on Mining Stock Daily. There's a number of things we have got to cover here, not only with precious metals. We're going to talk about major markets, and we're going to talk about implications of a few other things that are happening in headlines throughout the U.S. and around the world. It has been far too long since we have traveled up north from Denver along I-25 to visit with our friend Michael Oliver from MSA. Mike, listen, it's a beautiful, I think it's one of the most beautiful times of the year for Colorado. We have fall foliage in the mountains. That's about calling it quits. And then all of a sudden the fallness, I guess, starts hitting the front range here. It's just a beautiful time of year. So it's a great time to connect with you, my friend. How have you been?
Oh, just great. I love it here too. We've been here since 2020 now. I'm going to stay here forever. That's it.
Well, you can't go anywhere. You can't go anywhere. It says that. So, listen, we got a few things to talk about. We're going to go through some things that we have some of the charts, and you actually provided us with one of the latest newsletters that you had published to your subscribers. So we're going to share that. So if you are listening to this, I would, recommend, sometime maybe following through on the YouTube channel so you can see exactly what Mike's going to be talking about. But here we are, Mike, end of the week. We have weakness in the labor market. We have a rate cutting cycle back upon the table here. We have big markets, the NASDAQ, S&P trying to climb to new all-time highs. Then we have precious metals absolutely just, I guess I will say, raging higher. It's like we can't find a calm day in gold and silver, platinum, palladium at all in the last couple of weeks. So watching all this, I've heard you a few times with our friend Grant Williams, like none of this is coming as a surprise to you, is it?
No, it's an ongoing bull trend. It's, everybody tries to find in any market trend a reason for it. And usually the reasons for a bull trend or a collapsing market, either way, is one, they got too extreme for too long, either too high or too low. Case of silver, we argue, too low for too long, especially on a relative basis to gold. And then when they turn up, they don't need a reason. The reason already occurred and was ignored. And so people are looking for a headline like, well, why is silver gold? Why is gold going up? Why was this stock, et cetera, et cetera. And usually it's stuff that's embedded, already built into that market that it needs to do. Okay, anyway, that's a broad comment, but I think it applies.
So maybe let's talk about some of those fundamental reasons about, the why. what are the things that were embedded in the market that nobody was paying attention to? What was the most important
Well,
aspects?
the ongoing thing of gold and monetary metals, so I call them monetary as opposed to like platinum, palladium, which are precious, but there's a difference between precious and monetary. 3,000 years of history, gold and silver being money, okay? If you look at, like, go to a Federal Reserve St. Louis, their FRED chart, they call them, and go to an M2 chart, money supply, okay? And just look at it. Go back 50, 70 years, however far back they go, a long time. And look at, and move your little arrow along and like go to the first of the decade, January of 1970, and then go to January of 1980 and 90, and write down the number. What was the money supply then? It's parabolic, okay? And meaning the decay in the real value of the stuff in your wallet. We're a miniature, most countries in the West are, miniature versions of Venezuela. Okay, we made fun of that a couple of months ago. We put a Venezuelan stock chart on page 1 and said, boy, we should be long Venezuela, because the chart is parabolic, the stock market. And you say, well, that's great. No, it's not, because the degradation of the money ongoing constitutes the explanation of why the thing's going straight off the page. So is the price of dog food or a roll of paper, was exploding as well. Well, when you go back, that many decades in the U.S., basically the money supply increases about 90%, almost doubles, in other words, every decade. Sometimes more, sometimes less, and especially when the central bank gets nervous about this, that, or the other data point. Usually that's associated with the stock market downturn when the data points really start to go sour. Then they start printing more, okay? Well, gold goes up and holds its value against that ongoing degradation. And silver does too, although it's been lagged, especially over the last couple decades, to what gold has been doing. Gold's way above its 2011 high. Heck, copper is above its 2011 high. And there's a lot of base metals out there that if you circle where you are now and go back to where, 10, 20, 30 years ago, you say, gee, silver. Silver has made a mistake. Investors in silver have made a mistake. This happens in markets. You've got enough experience. If you go back to 2007 and 8, the market collapsed for reasons that, the guys in the story, they knew why it was going to collapse. They knew a couple years ahead of time. And yet the market wouldn't do it. And then finally it did collapse and paid its dues for that which it already had done and failed to compensate for. So I think silver right now is in one of these situations where not only is monetary metal going up, gold especially, the mama market, and silver's coattailing it, still very undervalued to gold, but it's catching up and it's erasing years of underpricing relative to a lot of things, to gold, to the degradation in the money unit. For example, if you just arbitrarily go back a quarter of a century, it'd be the October of 2000, okay? And look at the S&P. Right now it's up 3.5-fold from where it was then. It's actually less than the degradation in money almost. Goes up 11+ fold, okay? So it's held its value against degradation of money. And that's a factor that's ongoing in all markets. And there's times when, let's say, the stock market reaches a bubble point where it's been ridiculous for too long, overpriced versus reality. And there's a lot of fundamentals out there that, that normally look at, the earnings and so forth. And those don't seem to work precisely, but they're a ballpark warning, and yet it's still up there. So markets make mistakes, and when they do, the erasure of that mistake is often horrendous. Like, let's say the dot-com top, NASDAQ 100, for example. When it turned down, S&P went down 2 years to 2002, 50%. NASDAQ 100 went down 82%. You're talking about cleansing, okay? And it wasn't that what it was up there for was wrong. In fact, the dot-com bubble was totally valid. It changed our lives more than people even thought, and the internet did. And yet it still erased 82% of it. And it took it till 2016 for the NASDAQ to even get back to the price it had been in 2000. So, a lot of the point being that a lot of these things that happen, like if the stock market's going to top, as we argue it's topping, or the monetary metals are going to accelerate now, it's because of not factors that are necessarily new headlines, but old stuff that's finally getting recognized. And I think that's where we are at a very dramatic point, especially for silver.
Okay. We're going to spend a lot of time talking about silver here in just a few minutes. I know you're chomping at the bit here, Mike. But before we do that, I want to kind of dive into a little bit of the stories, the fundamental drivers here behind precious metals. And I keep on asking people who've come on this podcast for the last couple of weeks, maybe we can say the move in the last 18 months in gold. We should have a sense of what that narrative was telling us. Obviously, we can have the technical analysis. We can watch the charts. We can say it busted out of its cup and handle. We can get price projections here following that based on relative moves, all those things. But if you sit here today with me and you talk about, okay, this is what gold has been telling us. This is the narrative behind the move. What would you say that narrative has been? And I think more people are maybe more concerned about debt, more concerned about, a manipulation of interest rates to try to save face. And now we are starting to see more and more weakness in the labor market. We got JOLTS data earlier this week that looked not great. And then ADP numbers that came out this morning as we record Wednesday were just awful. Negative 32,000 when expected positive 50. And then there was a revision from August that was actually negative when they reported 30. And on top of that, because of this government shutdown, we probably won't get the payrolls report on Friday because the government shut down. Yeah. That actually might save some face for the federal government now that they're shut down. So, I mean, this is just wild. So this narrative, what has gold been telling us for the last 18 months?
Well, what gold? Okay, I think it's telling us that, one, it's anticipating, and gold's not some dumb market that follows headlines. There might be a day here or there where, something happened in Iran. We dropped the bomb and therefore, whatever. These excuses come and go. People like to latch onto them and say, well, that's why it happened. Okay. But it's ongoing, and gold knows that if, one, we have the biggest stock market bubble in U.S. history, which we've been arguing you do have, both in terms of age of the bull market, most of the bull markets in the past that we call bubbles, like the .com or 29, they were only 4 or 5 years. And the multiple gain was like 3 or 4-fold at most. And then you still collapsed. Well, we've gone up, 20-fold in the NASDAQ since 2009. S&P's gone up maybe 10, 11-fold since 2009 low, which because, 700 level on the S&P. And the duration has been like triple the norm. And you can look at a money supply chart or a Fed funds rate chart, the short end of the market, of the debt market, and see why. Because we've been given a Cheech and Chong injection of happy money, free money. In fact, 10 of the last 15 years, the rates were effectively zero. You go back 75 years, and even when they raise rates to 5%, that's low compared to the last 75 years. That's in the lower quadrant of the rate levels. Okay, so the stock market's been fueled by free money. And that's why, like, the stock market's up today. Why? Great unemployment report. Why is it great? Because it means the Fed's are going to cut and print. They got more excuse to print. And that's all we care about. Give us more injections, boys. And that's in effect, it's a miniature Venezuela market. Print the money, we'll go up, okay? So will the price of... When I was a kid, a loaf of bread was 20 cents, okay? What is it now? When your granddad built a house, it cost, the median price was $4,500. Now it's $450,000, okay? What does that reflect? Degradation in the money unit, period, okay? And when the Fed has more incentives in this ECB and the Bank of Japan have more incentive to print, that money goes somewhere. Now, quite often it'll go to the stock market. But even the stock market historically will get to a point where it says, golly, I've gone too far with this game. And it breaks. And when it starts to break, people with assets who are smart will begin to get out and move somewhere else. It's never the case where everything goes down. That argument is not true. Gold has always risen in bear markets. Back in the 1930 to 32 bear, after the crash, we had a big rally in the stock market back halfway to the high, and then the bearish market started. It went down like 80%. Gold miners, you couldn't buy gold because it was illegal. Okay, government knows best. But homestake mining went up like 1,000%. Okay, during the huge bear market in stocks. Similarly, 2000, 2002, stock market went down big. What did gold do? It was advancing. It kept advancing till 2011. 2007 to 2009, stock market went down big. During that time, except for a month or two in there, an interruption, gold went up big and continued on up big. So the money goes elsewhere. Gold is getting some of that money already, not just, certainly not from U.S. investors, but from foreign investors, governments as well. But when the U.S. stock market shows another fracture, not that headline chasing sell-off that we had in April, tariffs would sell it, okay? The reason for the market to go down is not some new news. It's based on, one, the massive excess of the past 15 years finally has reached a point where even if they keep printing, it won't help. Why? Because in 2000 to 2002, the Fed printed like crazy to save that bear market from happening. It didn't work. They started cutting rates in 2007. In fact, that's what printed the top.
Your way of approaching markets using momentum as your indicator has been incredibly useful with some of these big moves, the 2000 techs, the GFC, and you and I have chatted about that over the last few years. And so as you've lived through those and you were able to protect your own capital, clients' capital using, what you do best with momentum, I'm just kind of curious on the cover of this, what makes now any more different, but also similar compared to the 2000 and the 2006, 2007 rotation?
Well, gold's more dramatic this time, obviously. Okay, but that's only on a point scale. Right now, a lot of people are looking at gold and think, well, gold's going ridiculously. It's look at a huge amount of dollars up. But actually, in net terms, it's still not. It's not even. It's approaching halfway of what happened in '79 to '80, and what happened in the 2000 to 2011 bull market. They were both eightfold gains from prior bear low to prior bull high. And ultimately, late in the move, you understood why. Oh, yeah, okay, now I understand. First, an asset class movement out of a degrading asset that had been bubbled, and it broke. The money went somewhere, usually went into T-bonds or gold, or both. This time, it's primarily gone into gold. T-bonds have been in a lateral range for 3 years. And that's its primary driver, and we're not even close to the metrics, the dimensionality of those moves. So people who are arguing, they look at a price chart, oh my gosh, this is too much, too fast. You're looking at dollar terms, look at percent gain. Gold has to go to $8,500 to match the percent gain that it had in the 1980 peak versus its 1976 low, or from its 2001 low to its 2011 high, eightfold move. We'd have to go to 8,050 because our bear market low was 1,050, okay? So we're not even started in terms of catching up to those. And I think a lot of people miss that. And the reason is those basic long-term underlying asset flows. The Fed creates degradation of money, the money goes somewhere. And when they accelerate the degradation of money, and the investors finally decide, I'm not going to keep playing the game we've been playing because I perceive risk, stock market. they move it somewhere. And I think that the place they're going to move it now, more so, is into gold and silver, but also into basic commodities. Commodities are vastly underpriced historically to themselves and to other asset categories. Like the Bloomberg right now is around 104 or 5. Its high in 2008 was 237. Okay, so we're not even halfway to it. So anyway, this is the main driver. It's not so much a specific thing. It's the broad context. And yes, some of these specific things help explain that. And right now, certainly the stock market doesn't care about, quote, economics. It cares about, a bad number, bad economy, great, Fed's going to print. Well, that drugged out game historically never continues. There's a point at which it finally breaks on its own. I think we're there. Our technicals say do not trust this stock market. A new high by 10% by the S&P over the January high. You wobble back down a few more percent points, you're going to go back through that high. And then people will say, oh, I thought we had a breakout. And that's when the panic's going to hit. Meaning that people in the stock market who felt comfy will suddenly feel uncomfy. And they'll go to where, it's comfort.
Yeah. We're gonna go over that. One last question before we go to the charts here. Mike, I love talking to you because you challenge me to think critically about these market moves so much to the point I start doubting myself. But I'm watching, obviously I'm watching the price move here in gold. I'm watching this thing just every day continue to go higher, and I'm begging for a healthy pullback.
Yeah.
Just a week of just doing nothing but hanging out. Maybe
that's fine. Yeah, you can get those any time. We just had 5 months of that. April, May, June, July, August. There were repeated sellers. 3,500 had been the high. Mostly you get up in the mid-34s, they'd sell it. It'd go down. Wouldn't go anywhere. Come right back up. Go down. Go up. It was a sideways range of frustrated sellers who thought, oh, no, we got to go back to 2,800 or some prior high. And now, of course, they think, well, we're near 4,000. We got to go back to 3,500 and test the top of that range. The game hasn't worked. Something's going on here, guys. Can't you figure that out? You don't make a top in gold by going sideways for 5 months. When gold tops, it tops, okay? Anyway, this is the big story in my view. In fact, in my career, I think this is one of the biggest stories that's about to happen. And I've been in these markets since I got hired by Hutton as a futures broker in 75 after gold got legalized. So 50 years. This is a monster that's about to unleash.
Hey, well, just before we let you go anymore, Mike, I just put up a screen share of your newsletter that recently. So we'll be sharing the screens. If you're listening to the audio on the podcast, don't watch the video while you're driving, obviously, but refer back to the YouTube channel, and we'll, Mike and I will do our best to kind of describe what we're seeing here. But I do recommend, going to the YouTube and watching what he's talking about. So go ahead, Mike. We got the log scale here from the silver.
Well, this is it's 50 years of silver price. Okay, it's plotted on a ratio scale. So in other words, a move from 10 to 100 is the same as going from 100 to 1,000 in terms of multiple gain. And this is silver. And you can see the surge back in 1980. And there's when you go to YouTube and see it visually, you'll see we've got an arrow that spans the last couple of quarters of that multi-year move. Remember, it started in the summer of 76 and went up to 1980. But in the last 2 quarters of that bull market, silver went from $8 to 50, compressed in the last handful of months. Okay. And peaked. Okay, so we've marked the dimension of that move in the last couple quarters of that bull trend with this red arrow showing the size of it on a log scale. Then we go back to the next bull market, which was in 2010 and 11 when silver went from, it had been going up for a couple of years, quite a few years since the early 2000s, just like gold. And then so it was an aged bull market. But then all of a sudden in 2010, something happened, and I'll explain what that is later. And the price of silver went vertical for the next couple quarters, from like, the 17, 18 bucks to 50s, all compressed in the final handful of months of what had been a decade-long bull trend. Most of the move occurring in the last couple quarters. What caused that? Okay. And then I show the current bull market, which again started, back in 2015. Silver wallowed around while gold advanced and went sideways, $15 to $30 and so forth. We went up into 2021, got up to 30. Then we went into a range again for 3 or 4 years where silver just was stuck with a cap at about 30, making higher lows then in the pullback. It got down into the 20s again, I think. And then in 2024, we emerged above that 30 level and started to advance, but still not an explosion, just, a persistent process. I think we're at the cusp now of that accelerated phase, where in the final 6 months of the move, silver prices itself into a different reality. The reality of the last 50 years has been capped by $50. And those were even isolated peaks. And it's not like you lived up there for very long. It was really days or, a couple of weeks. Most of silver's action's been in the $20, $30 range for 50 years. Okay. So in real dollar terms, if you measured silver against the degradation of the money unit, it has been going down, in real dollar spendable terms per ounce. And I think we're about to launch not only through those dual highs at $50 that everybody knows. That's not technically significant to us. That's a price level that is a relic, really, because you're talking 1980 at $50. Heck, in real dollar terms, silver would probably have to be over $200 right now just to match the 1980 high in spendable real terms, okay? And even the 2011 high at $50, we'd probably have to be well over 100. But anyway, I think we're about to launch that handful of months acceleration that drops jaws and is, frankly, to be expected. Where silver says, I've had enough. You've made an error. I've been depressed for too long on a relative basis to gold and a relative basis to a lot of things. I'm going to catch up, and I'm going to do it so fast. If you're not there, you're going to miss it. Yeah, you'll make a high, but I suspect that high is going to be so much higher than we are now that if you're fearful of the correction that comes after that high, you're going to miss the move. Now, there's a key trigger level that we're looking at that will signal the onset of this handful of month acceleration. Yeah, we can get to that next.
Okay. Before we get there, Mike, I want to say, there's two things that keep popping in my mind looking at this chart. One is that, cup and handle formation we're seeing here. We got this shape, but also that's saying that my good friend Sean over in the Carolinas told me, if he's listening, he'll know this, ain't no such thing as a triple top. So those are the two things. Those are the two things picking up my. So okay, moving down to the next one.
Yeah, this is current charts. The top chart we show, again, go to YouTube to see it, is back, if you recall, back in 2020, there was a surge in gold and silver, a dramatic surge that lasted about a handful of months. From March through, for silver, from March through late in the year, in fact, silver went from $15 to 30, okay? During that time, silver handily beat gold's upside on a percentage basis. And the silver to gold spread, now let me explain how we measure the spread. Most people do the ratio chart, 70, 80, that kind of thing. We measure an ounce of silver divided into an ounce of price of gold, express it as a percent. And if you go back 50 years and look at what was the highest level that spread was in the last 50 years, you'll see that in the bull trends, 79, 80, 2010, 2011, silver got up to 3.5%, and even higher in 1980, up to 6% of the price of gold. But during 21 of the past 50 years, even in non-bull market years, silver's at least been 2% of the price of gold. Well, right now, silver's at 1.2% of the price of gold, and that's been a sharp advance over the last 5 months, by the way. It was under 1%. So silver's value to gold, while it's been going up with gold in price, has been degrading, especially since that 2020 surge where silver beat gold. Silver then got up to 1.5 something percent the price of gold, still fairly low, but retreated all the way back down under 1% again at that recent low in April. Since April, it's surged from 0.9 something percent to 1.2%. And when you look at the spread chart, you're already starting to break out above a downtrend on that spread, but there's a ceiling where if you go back to 2022 and 2024, that spread reached a certain level around 1.31%. They'll get worried about the details there, but
the red line.
Yeah, there's a red line on the spread, but there's a horizontal line, meaning if you go back there a third time, you're at a, quote, triple top. Don't count it stopping. Okay. But we also run momentum of the spread, just like we run momentum of price. And when you run a momentum chart of that spread, you see a slightly different picture. One, you're challenging right now that ceiling on momentum. The spread, again, is at 1.2, and it needs to get to 1.31 to be there. Okay, so it's not quite there. But the momentum of the spread is, as of last month, and today it may, with today's action, might even be nudging above that. Momentum of the spread is breaking out. Now, that indicates to us that silver's about to shift into a strong outperform relationship to gold. So as gold continues up, silver will go up more on a percent basis, be the better place to be, just like it was in 79 to 80 or 2010 to 11. In the tail end part of those bull markets, silver went berserk relative to gold. And at no time in history, when this spread turns favoring silver, does it mean downside in price of gold more than silver. It always means upside of price of silver more than gold. So it's always not just favoring silver, but it's also saying the price of both metals is going to go up, except silver is going to beat it. We're on the cusp of that. Now, why is that important? It is the exact same spread situation occurred prior to those 5 to 6 months surge late in 79 to 80 and 2000, October 2010 to April 2011 on silver, where silver's price went off the page upside relative to gold, but it was pre-signaled by this spread breaking out. We're exactly there now on this spread. It's telling us that not only are both metals continuing up, but we're at the point now where silver could go vertical. And then the issue becomes, well, what's vertical? Take out 50, yeah, a lot of people could be impressed. That's really a minor indicator to us. We're right now just below 48 as we speak today. Okay. The spread says that when you break that spread out, and again, let's assume this month does it, and we're intra-month, we're doing it right now, and you break the spread out, not just the momentum of the spread, but the spread gets up to the 1.3 something percent, you could easily go to 2% in a heartbeat. Well, that's a huge move. Yeah, when you go from 1.3 to 2, that's not a doubling, but that's, it's huge. And it's like buying a stock at 130 and it goes to 200 quickly, okay? But right. I don't think you'll stop at 2% because in bull trends, the silver spread always goes to at least 3, meaning we could be at a position now where if this spread breaks out, not only is silver going up more than gold, but it's going to double in value to gold over a handful of months. So not only an outperformer, but a vast outperformer. And it also will convert into a vertical net price gain in the monetary metals, where what you've seen recently in gold and silver is nothing compared to what you're about to see when this spread breaks out. And I think we're on the cusp of it right now.
Yeah. What an amazing theory here. And it actually goes hand in hand, Mike. I don't know if you're familiar with the work that Jordan Royburn does of the Daily Gold, but him and I did an interview a number of months ago, and part of it we were talking about gold, we were talking about silver, and when silver has those breakout moments. Usually the move doesn't happen, it lags. Gold moves first and then silver moves sometime, but silver's big moves typically happen after rate cutting cycles. While gold kind of sniffs out rate cuts, silver patiently waits until that cycle begins, and that's when it starts really outperforming. And that's exactly where we are here. So your idea here with momentum is sitting hand in hand with, the historical backdrop that Jordan shared with us here on the podcast. So it goes hand in hand. It'd be interesting to go back and get you two together.
That could be a background factor as well. But our focus right now is on this trigger point, because in the past, when you look at those two parabolic moves, it's what caused that, okay? What technical signal? Because already silver was in an uptrend, so it's not like it started a bull market then. It had already been in a bull market. What caused it to accelerate is the key. And we think it was this spread relationship caused the flow of money to go into silver, because when it broke out, it woke people up, especially people on the industry side. But silver right now is vastly undervalued historically to where its normal price is, even in a commonplace year. Like I said, 21 of the last 50 years, it's been at least 2%. Didn't even require a bull market most of those times for it to be there. We're at 1.2. Okay, so wake up. You've got a situation here that is pending, and it looks like it's explosive. And it will happen not slowly, but it'll unfold so quickly. Now, you've got to also be aware that in the middle of both of those moves, where we've been up like 5-6 months vertically, there was a 1 month phenomenon of a correction that fooled people. So like after about 3 months of upside gush, you get this month that says, oh golly, I made a top, okay? Don't count on it. Now also there's another issue. Well, where might silver go? When we do a study of the logarithmic percent gain, once that spread broke out, where was silver then? What percent did it gain over that next 6 months? Well, it was different. 79 to 80 was far more on a percent basis than it was in October 2010 to April 2011. But they were both very dramatic, obviously. If we then take those logarithmic moves, not point value, not dollar value, but the percent scale move of each of those swings post the breakout in the spread, how much did silver gain? And you lay them on top of the current chart, it argues that at minimum you're going to see $100 in the next 6 months, and you quite likely could see $200 in the next 6 months. The issue will be, in my view, where are you in that first half of that surge? In other words, if it takes us 3 months just to get up to, let's say, $70 or so, and then you have a correction, then maybe in the next 3 you only go to 100. But if all of a sudden we find that in 3 months, the first half of that move, you reach somewhere around 100, then watch out. There's a potential we could go to a couple hundred. And by the way, in real dollar terms, as I've said, based on the degradation in the money unit, if silver were 200, it'd merely be matching something like that 1980 peak. So, ponder on that.
Yeah.
I think we're sitting on a unique situation here.
You give me a lot to ponder about here, Mike. That was about loss for words.
Yeah.
Is there anything else?
You go to the next page, and I'll show you. I'll show you the chart. Here's the 2008 move, for example. Spread chart is the top one. It shows the same ceiling type action that prevailed for a couple of years, just like ours has prevailed since 2022, 2023, 2024. The highs were all at that 1.31%. Well, back then it was a different level. It was like 1.6%. So, but there was a ceiling on the spread, the top chart. And when we've circled the green point where the months that broke through that ceiling on the spread relationship between gold and silver. And it's at that point where price went vertical. And then below it, we've posted the monthly price chart of silver and the monthly price chart of gold at that point where the spread broke out. And gold then was like 1,300. And then, by the next 6 months, it reached up to about 1,580 or so. Nice move. But silver went from 20-something dollars to 50. Far more vertical. Ultimately, gold went up to 1,900, but that was a more laborious part of the move. But in the next 6 months, silver left the page and gold continued up nicely. But that spread announced the point of the rocket launch in silver. I think we're at the same point now where silver back then, between 2008 and 2010, had been going up nicely. It went from, $9 up to 20-something. Nice percent move. But it was laborious. It ceased to be laborious when that spread broke out. Silver just took off like a rocket. And therefore, we're highly focused on what that spread is doing, because that was the signal indicator in 79 and 2010 that silver's going to go berserk. This is just an example of that anatomy of that move.
So if you have been participating in these markets here, Mike, and you've had a wonderful 2025 best returns in your precious metals equities portfolio you've had since 2011.
Mm-hmm.
And you're sitting here like, boy, buying here, you're saying to yourself, buying here sounds like a fool's errand. It's just things have gone up so much. Mm-hmm. If we look back 6 months from now, we'll come back to this interview, will we be saying, boy, some of those equities look pretty damn cheap now that I think about it?
Yeah. Imagine what it's going to do to some of the miners. Now, the silver's in a unique position fundamentally because its primary production doesn't come from the silver miners.
No.
And therefore, when its price goes up, it doesn't entice a massive inflow of new production. Right. Why? Because most of the mining comes from lead and zinc, and the miners who get that stuff out of the ground aren't primarily focused on the tertiary market that they're also bringing silver out of the ground. It doesn't cause them to go mine more heavily and aggressively just to get the silver because it's a minor portion of their output. You get the point. So silver's got a unique supply-demand situation as well, but we don't get into that. That's just a background feature. And I just think silver's going to reprice itself at $100, $200. And you're going to get sell-offs from there, but you ain't coming back to 50 or 20 or 30 or anything like that. You're going to be in a new reality. Silver's going to be living at a level that just has been living in the last 50 years, between 50 and 10. It's going to be a new level it's going to be living at. And I suspect it's going to be like 100 to 200 somewhere. The key is to catch that move. And I do not think it will be incremental.
Okay. We got a few minutes left, and I did promise people, you mentioned about the general stock markets looking to roll over. So I just wanted to bring this up, and we don't have to spend too much time on it as we have with silver, but I do think it's worth mentioning here. I got the S&P up here, the 100-week momentum chart that you like to share. Mm-hmm. Can you walk us through what you're seeing here with momentum in the big?
Well, this happened in 2000 and also 2007, where you made a high. In fact, we turned bearish in January 2000, and the market made a new high in March, marginally. Pull back again, went up, made another new high monthly close in August. It didn't really start to fall apart till 2001. And this is a year after momentum said, you're no good. And sure enough, if you got out of the market in January, you missed another 5, 6, 7, 8% of laborious BS action, up, down distribution. And then you had a collapse that, killed you. Same in 2007. We got to a target zone minimally in May, had a sharp pullback into the summer. And again, in late 2007, in September, the Fed cut rates finally. Okay? That caused the final rally that lasted into mid-October. Lasted for a month, buying the cut news. That was the top. What did it do? Silver took out the all-time highs. The May high of 2007, which was what? 1550. What was the high in 2000? 1550. A dual top was broken through because the Fed cut rates in September 2007, laborious topping action in 2007, because of a Fed rate cut. Why? Because they knew the mortgage crisis was coming, although they denied it. And the market partied, and that was the top, a triple top price breakout. 1550, 1550, then in October, 1575 of 2007 was the top. So it's laborious. We're going through the same thing right now. The problem is, from a momentum perspective, if you get the chart and look at it, price has punched out the January high on the S&P or the February high, and momentum has not. When you look at the momentum chart, you say, ooh, it's up under the structure that it broke. So if the bottom chart were a price chart, you'd be wanting to sell. The price chart looks like I'm going to go up forever. The momentum chart says, no, you're not. We have a debate here. This is what often happens technically when you're at the top. Momentum will break down first. Price will break down second. Momentum usually tells you ahead of time. Right now, momentum has already told us, don't trust the new highs. They're likely not sustainable. Yeah. And that when that money flows out of there, that's further fuel for gold and silver.
All right. Incredible insight here, Mike. I can't thank you enough. I'm almost lost for words. I don't know. I don't know. I mean, maybe my best question, my follow-up question, Mike, is, okay, what am I forgetting? What should I be asking you right now? I mean, you're in the weeds here. You painted a pretty big picture here, precious metals and where we're at with momentum in the market. What should I be asking you? What should anybody be asking you?
I think you just got to be, if you're in the stock market, and that's the only thing makes people smile right now, the average middle-class guy or guy's got a retirement account, he's a retired government employee. Hey, at least my 401k and my retirement account's up on the year. It's not up much, by the way, but, it's up on the year, and it's going to go forever because I could just tell, because NVIDIA's up there, right? You're going to watch the financial sector. When that goes down, there's nothing to smile about anymore. I mean, we know the consumer credit problem is a crisis level. The defaults on credit cards, the credit cards being maxed out, delayed delinquencies on tax filings, all kinds of metrics like that. Unemployment, you mentioned this, earlier. All these things don't look good. Yeah, my retirement account looks good. You take that away from people, and suddenly you have emotion. But when you get emotion, all kinds of things change. And I think we're on the cusp of having serious emotion, not just because of the stock market, but because of certain other points of uncertainty, like expectations that, commodities are going to stay low and oil's going to stay low. Don't count on it. Oil's got a trigger above it about a handful of dollars this quarter above where you are right now. You better not go back up into the high 60s again, because if you do, it's going to explode. And that'll be hard to explain for some people because they thought, I thought we was going to keep it down. Uncertainty is the key issue because that creates emotion. And that's what comes into play, especially at points that we were talking about with the monetary metals, when emotion comes into play.
All right, Mike, thanks so much for your time. I know we had a little bit of technical difficulty at the beginning of this, but we seemed to conquer that. And it has been quite some time since you were last on the podcast, and I have to admit this was well worth the wait, but I promise you I'm not going to make it as long for the next time you and I talk. Momentum Structural Analysis over at olivermsa.com. His reports will give you so much to think about. You might want to go hide into a corner sometime. If this podcast interview didn't make you do that, I don't know what will. But Mike, thanks so much. Good to see you once again.
Thank you, Trevor.